Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Risun Group Limited annual report. China Risun Group Limited is a diversified company that operates in various sectors within the Chinese market. The company's primary business involves the production, sale, and distribution of coke, coking chemicals, and refined chemicals. Its products include crude benzene, industrial naphthalene phthalic anhydride, coke oven gas methanol, coal tar, high purified hydrogen, and caprolactam. In addition to its core business, China Risun Group Limited also provides operation management services to third-party producers of coke and refined chemicals. This indicates the company's ability to offer value-added services beyond just production and sales. Furthermore, it engages in trading activities for coke, coking chemical, and refined chemical products, both domestically and internationally. The company has expanded its scope to include real estate development, where it develops and sells commercial and residential properties. This diversification into a new sector demonstrates China Risun Group Limited's adaptability and willingness to explore opportunities beyond its core business. Overall, China Risun Group Limited operates in 5 main segments: coke and coking chemicals manufacturing, refined chemicals manufacturing, operation management, trading, and others. Its services and products cater to various industries, including iron and steel, non-ferrous, coking, and chemical sectors. China Risun Group Limited market capitalization of 14 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that China Risun Group Limited holds a significant advantage in their industry. China Risun Group Limited trades at a higher price-to-book ratio of 1.02 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that contributed to these changes. Revenue growth was driven by several key areas. The production and sale of high-purified hydrogen saw a significant increase of 25.7%, while the sale of refined chemicals grew by 17.8% to RMB 17,796,457. Trading revenue also increased by 5.9% to RMB 5,956,004. Additionally, management services revenue experienced a substantial growth of 92.5% to RMB 92,488. The company's expansion and investment in new production capacity, such as the completion of the Pinxiang production base with an annual coke production capacity of 1.8 million tons, also contributed to revenue growth. Furthermore, the provision of operation management services for third-party coke enterprises and the centralized sale and marketing advantage were key drivers of revenue growth. On the other hand, revenue decline was primarily driven by a decrease in the sale of coke and coking chemicals, which dropped by 0.1% to RMB 13,515,076. The refined chemicals manufacturing business also experienced a decline due to strong supply and weak demand, resulting in a price drop of chemical products across the board. The company's interest income decreased by 41%, from RMB 225,651 in 2024 to RMB 133,423 in 2025. The coke and coking chemicals manufacturing business saw a significant decrease of RMB 4,127.2 million, 23.4%, due to declining ferrous industry chain prices, increased coke production volume with decreased demand for coke, and lower steel price despite increased demand for steel materials. Overall, the company's revenue growth was driven by its expansion into new areas such as high-purified hydrogen production and sale, while revenue decline was primarily attributed to a decrease in the sale of coke and coking chemicals. The net income of the company underwent a significant fluctuation over time. Initially, it experienced a substantial increase of 50%, indicating a period of growth and success. However, this trend was short-lived, as the net income later decreased by approximately RMB 425.3 million, representing a decline of 12.2%. This downturn suggests that the company faced challenges that impacted its profitability. In terms of profit margins, there were distinct variations across different business segments. The gross profit margin for the overall business remained stable at 7.8%, but this masked significant changes within specific areas. The coke and coking chemicals manufacturing business saw a notable increase in gross profit margin from 8.6% to 12.4%, indicating improved efficiency or pricing power. Conversely, the refined chemicals manufacturing business experienced a decline in gross profit margin from 7.3% to 4.5%. This disparity highlights the need for targeted strategies to address the performance of individual business segments and optimize overall profitability. The company is indeed generating positive operating cash flow. This is evident in the financial statements provided on page 49, which show that both 2025 and 2024 have net cash generated from operating activities in the positive range. In 2025, the company recorded a significant increase in operating cash flow, with RMB 3,464,900 being generated from its core business operations. This is a substantial improvement over the previous year's figure of RMB 1,436,267 in 2024. The consistent generation of positive operating cash flow indicates that the company has a solid foundation for future growth and sustainability. The company's debt level has experienced significant growth over the past period. According to the extracted summaries, total borrowings increased by approximately RMB 4 billion, 13.2%, to RMB 34.4 billion, indicating a substantial rise in debt. Furthermore, restricted bank balances and bank loans secured by restricted bank balances also saw notable increases of 26.6% and 37.1%, respectively. However, the interest expenses do not seem to have kept pace with this growth. Despite an increase in total borrowings and floating rate debt, finance costs actually decreased by RMB 19.9 million, 1.4%, while interest expenses only rose by a relatively small amount of RMB 6.9 million. This suggests that the company's increased borrowing has not yet led to significantly higher interest expenses. The company's performance varied across different segments and regions. On the positive side, refined chemicals manufacturing and coke and coking chemicals manufacturing performed well, with significant increases in revenue and results. Refined chemicals manufacturing saw a revenue increase of over $2 million from page 11 to page 12, while coke and coking chemicals manufacturing experienced a similar surge in revenue. Operation management also reported a positive development, having signed a new agreement in June 2025. The trading segment, however, performed poorly across multiple pages, with decreasing revenue and negative results. Hydrogen energy products, on the other hand, showed improvement, with successful completion of procedures to add new categories to its hazardous chemicals business license. In terms of regions, Jilin Province, China, and the Beijing-Tianjin-Hebei area reported positive performance. However, the coke and coking chemicals manufacturing business in certain regions decreased by 23.4% in revenue, indicating a decline in performance. Overall, while some segments and regions showed improvement, others struggled with declining revenue and negative results. Management is optimistic about the company's outlook, citing several key points. Firstly, they expect a decrease in depreciation expense due to the extended useful lives of property, plant, and equipment. This will likely lead to increased profitability. In addition, management notes that the company has a rigid cost advantage in methanol production, which has contributed to an increase in gross profit. Furthermore, the trading business volume has seen an uptick, resulting in higher earnings per share. Specifically, basic earnings per share have increased by RMB 0.8 cents due to an increase in net profit. In terms of liquidity, management is confident that the company's requirements will be met through a combination of cash flows from operating activities, bank loans, and other borrowings, as well as the proceeds from fundraising activities. Overall, these points suggest that management is positive about the company's prospects for growth and profitability. The company has a history of paying dividends to its shareholders. In recent years, the company has declared and paid various dividend amounts per share for both interim and final periods. For instance, in 2024, the company paid RMB cents 2.22 per share as a final dividend and RMB cents 0.78 per share as an interim dividend. Similarly, in 2023, the company paid RMB cents 1.2 per share as a final dividend. In addition to paying dividends, the company has also proposed a new dividend amount for its 2025 final period, subject to approval. The proposed dividend is RMB 0.19 cents per ordinary share. Furthermore, the company has disclosed that it has paid out approximately RMB 8,130,000 in total dividends since March 2019. This demonstrates the company's commitment to returning value to its shareholders through dividend payments. That concludes the financial summary for China Risun Group Limited. Feel free to comment below, and I will be happy to answer them when possible.